Welcome to Wealth Standing Podcast. This is episode 448. Today is June 11th, 2024. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, tomorrow is yet again another Federal Reserve Open Market Committee. If you believe the narrative that they talked about back in November, then we should have been seeing something like the third or fourth rate cut at this point. We haven't gotten a rate cut. We most likely won't receive one tomorrow. And you can be pretty sure that no matter what the Federal Reserve says or what the inflation number comes out to be tomorrow, the market will have a knee-jerk reaction to it, just like it always does, regardless of what the facts really are. I receive a lot of questions about, do I think the Fed will cut? Will they cut? Won't they cut? On and on. I talk about this a lot because obviously it's part of the narrative and you have to. But at the same time, it really doesn't matter. Go back to last November. I was one of the few people that disagreed with the consensus that the Federal Reserve was going to have major interest rate cuts this year. In fact, my viewpoint was so unusual at the time that my friend Andrew Horowitz over at the Disciplined Investor podcast had invited me to come on, earlier this year to talk about it. Back in November, supposedly the Fed had done this dovish pivot. I didn't see it as such back then. And for that reason, and also for the extreme that the market took it, remember the Fed was at most talking about having 3 interest rate cuts in 2024. People in the market started to outdo themselves, and the general consensus ended up being that there would be 6 rate cuts in 2024, and some prognosticators thinking as many as maybe 7 or 8. Well, I didn't think that there was any way that that could happen. That's one of the reasons that I remained so cautious in the early phases of this most recent bull market, because I just didn't believe the narrative that rate cuts were going to happen at any point and that was going to be beneficial for the stock market. Well, here we are, something like 8 months later. I was absolutely right that there wouldn't be all these rate cuts, but you know what? At the same time, I was absolutely wrong because the market never pulled back in the face of the fact that interest rates were staying higher for longer. So the facts are the facts, but that doesn't drive the market short term. And despite all the headwinds of geopolitical uncertainty, I think in general the United States North American market will continue to pretty much stagger along. I do think we're overheated when it comes to some of the mega cap big names in tech that have led the indices. But if you look below the surface, under the radar, even though the major indices are at record highs because of those few names holding everything up, there are still plenty of bargains and value stocks that can be invested in when the time is right. Just looking at the S&P 500, about 34% of the stocks are trading at a price below their 200-day moving average. That's usually an indicator of value. You have about 52% or more of stocks, so more than half of the stocks in the S&P 500, even though the index itself is at or near a record high, you have over 50% of the stocks that are trading 10% or more below the recent 52-week high. That's generally considered a market in correction. And to take it beyond the correction level, you've got about 20% of the S&P 500 stocks are literally in a bear market trading at or below 20% from the recent 52-week high. Now, if you're a pessimist, you look at those statistics and say, there's a crash about to happen any day, the market's overvalued, and the glass is half empty. On the other hand, if you're an optimist, you look at that and say, hey, the glass is half full. This is a great buying opportunity in those stocks that are on sale. Personally, I consider myself to be a cynical optimist. A lot of those stocks have lower prices because they're probably worth less. There's probably a reason that their performance is lower, and I wouldn't rush out and buy them. Right? Sometimes things are cheap for a reason. On the other hand, if you do your homework and you dig into the data and you're not worried about what's going to happen tomorrow or the next day, then you can find stocks that are trading at not only a reasonable valuation, but also those that have potential for future growth. And those are long-term opportunities. As a cynical optimist, personally, that's what I look for. You're not going to get instant gratification. You're not going to get rich quick. But by being a cynical optimist, the glass is never half full nor half empty, because over time you build long-term wealth and your cup runneth over. Think about that. In any case, today I don't want to talk about specific stocks. If you follow my blog over at investablewealth.com, you know that over the past couple months, I've slowly been adding small positions within company stocks that I think do represent both value and growth. I plan to continue doing that throughout the summer, assuming no unforeseen events take place, and I just want to strengthen my position in the long-term potential for a diverse stock portfolio that's pretty much centered in the U.S. or within North America. And so that's a little bit of technology, that's a little bit of industrials, that's energy, utilities, just an entire portfolio that's diversified across many sectors of the economy, but geographically focused in North America and specifically with individual stocks that I think represent both growth and value. But I digress. Listen, the point of today's episode is to talk specifically about the Federal Reserve and to encourage you to just ignore all the media babble about whether rates are going up or down or whether it's higher for longer or whether the Fed is dovish or hawkish. I mean, the bottom line is when it comes to the Federal Reserve or any other person or institution, you watch what they do and not what they say. And when it comes to the Federal Reserve right now, regardless of what they say, they are already easing and they do have a dovish perspective, but I would counter that by saying that they're very selectively dovish in what they're doing. And overall, I actually think they're playing their hand pretty right. Here's what I mean by this. Regardless of whether the Federal Reserve cuts or doesn't cut, simply by talking about things, they can drive the market. So even if they aren't going to cut, they can talk about that there's a potential for cuts and that drives the market in anticipation of those cuts. On the other hand, if they are worried about inflation, without ever even raising rates, they can simply say that they're thinking about it. And again, they get the desired outcome simply by jawboning the market without actually ever having to do anything. So just like a magician that's doing a sleight of hand trick where everybody's looking at what the Fed is saying they're going to do, the real tell in the economy is the fact that they're not doing anything at all, which is generally what they have been doing for almost a year now. They're always telegraphing things, but they don't always do what they telegraph. And right now, to the extent that they're doing anything, it is dovish. They are already cutting without affecting interest rates, and they're doing that by how they're handling their balance sheet. Up till just recently, the Federal Reserve, even though they were talking about cuts and they were talking dovish, they were actually quite restrictive because they were letting their balance sheet roll off, meaning that all the U.S. treasuries that they hold, rather than reinvesting that money when the treasuries mature, they were allowing $60 billion a month, $60 billion a month, to roll off to mature and not be reinvested in government debt. Well, now, as of June, they've backed that off and they're only letting $25 billion a month roll off. Now, $25 billion is still no, minimal number, but it is more than 50% from what they were doing. And so in that regards, they are already easing. They are already allowing more money to flow into the economy by not necessarily printing more money, but by just taking less of the counterfeit money out of the market. So they are easing. Regardless of what they say, they are easing. But at the same time, I think you have to give credit where credit is due, and they are playing their hand pretty well. Much better than I think what the Japanese, the Bank of Japan did with their yield curve control. Our Federal Reserve is finding a sweet spot where they can reduce the amount of government debt that rolls off every month, allowing the government to continue their profligate spending and borrowing at lower government interest rates, while at the same time the Federal Reserve is continuing a restrictive stance on the overall economy, because while the Federal Reserve is letting their government debt roll off at a lower rate, they're not doing that with mortgage-backed securities. The Federal Reserve owns mortgage-backed securities going all the way back to 2008. They're currently allowing all their mature mortgage-backed securities to roll off every month. And so what that does is they're effectively keeping the government's interest rate payments lower while keeping mortgage rates high. Now, you may not agree with that depending upon what kind of political spectrum you have, but the bottom line is that's what they're doing, and it actually is a pretty good trick. Because right now, the government's running about 5 to 6% of GDP in deficits. That's one of the major reasons that the economy has done so well, especially over the last 2 years. There's tons of government money flooding the economy. By keeping government interest rates somewhat suppressed from a market rate, that allows that money printing engine to keep on running. The problem with all that government spending, while it does improve certain aspects of the economy, it also creates inflation, and that's why we haven't seen inflation put to bed yet. So what the Federal Reserve is trying to do with their form of yield curve control is allow the government money printing engine to continue by giving them suppressed interest rates, but at the same time, they want to keep things like consumer and mortgage rates high to keep inflation low because they're not, going to affect inflation on the government side. And again, whether I philosophically agree with their manipulation and their intervention isn't important, from a personal perspective. It's important to look at it from the overall economy and how this is one of the factors that's keeping the U.S. economy strong. So regardless of whether you philosophically believe the intervention should be done or not, the bottom line is that it actually is having a pretty good impact on the overall economy. Because, as you've heard me say many times over, more than a year now, I've talked about the Federal Reserve's interest rate policies only being one tool, right? The Federal Reserve couldn't stamp out inflation simply by raising interest rates because the Federal Reserve doesn't produce energy. They don't grow food. They don't build houses. All they can impact is the money supply. Housing costs right now are at the levels they're at, not specifically because of what interest rate policy is, but simply because there's a mismatch between supply and demand. We are still somewhere around 5 or 5.5 million housing units short, given the size of the population that we have. For whatever reasons, houses haven't been built over the last 15 years like they should to keep up with the demographic growth of the country. So the Federal Reserve can't make the housing situation better, but they can make it worse. And they can make it worse by having the extremely low interest rates that they have had over the last 10 or so years, especially over the last, pandemic years. By having artificially low interest rates below what the normal market would be offering, then you encourage people to take on more debt and buy more houses. So while the Federal Reserve can't build more houses, they can flood the market with money and encourage people without the money to buy more houses. By keeping interest rates high, they take those marginal buyers out of the market. And so the only people that can afford to buy a house are those that have the actual money. And again, there are more people with money than there are houses to go around. That's why housing prices haven't come down, even though the cost of borrowing to own a house has gone up exponentially in the last 18 months. And so right now, with the Fed's yield curve control, they're letting government bonds that mature, they're reinvesting $25 billion of that matured bonds every month, allowing the government to borrow at artificially lower interest rates while at the same time letting the mortgage-backed securities entirely mature and roll off to keep a cap on housing prices. Because to the extent the Federal Reserve makes mortgage interest rates lower, that will simply bring up the price of houses because, again, there's not enough houses to go around. So you're either going to pay more in interest or you're going to pay more in housing costs because it's a supply issue, not a monetary issue. In any case, tomorrow, when the most recent inflation numbers come out and when the Federal Reserve Open Market Committee makes their announcements, regardless of what the reality is, the market's going to have a knee-jerk reaction. I personally will be ignoring it. And I think if you want to take care of your long-term financial health and your mental health, you should probably ignore it too. Hey, until next time, as always, this is John Pugliano wishing you the very best returns.